Dette er et intervju som er publisert tidligere på vår Patreon, som er vår betalingsmurtjeneste. I forbindelse med at vi har lagt ut en ny episode som er et intervju med en AI-ekspert som er en aktiv deltaker og lytter av Tid og penger, så publiserer vi et eldre intervju fra vår betalingsløsning i den vanlige strømmen. Og dette er et veldig aktuelt, det er jo alltid aktuelt å vite hva sentralbanken gjør. Og dette er et intervju med Thomas Hoenig. Vi har hatt han på 2 ganger. Han var tidligere stemmende styremedlem i FOMC, i praksis sitter på rentestyret i USA. Vi går bare i gang med det intervjuet, med introen fra forrige gang. Da har jeg nettopp gjennomført intervju med vår, hva vi kaller han, friend of the pod. Tidligere sentralbanksjef, eller tidligere stemmende FOMC-medlem, som kan gi oss perspektiver som vi ikke klarer å nødvendigvis få selv. Thomas Hoenig nettopp gjennomført intervjuet, og tror du nettopp har hørt på noe. Hva du synes?
Jeg synes det var kjempebra, bare for å clarify hans rolle. Altså her snakker vi om et medlem i rentekomiteen, altså tidligere medlem i rentekomiteen til den amerikanske sentralbank, og relevansen av dette er jo i forbindelse med at de satte opp renten med 0,75 basispunkter for andre gang i år, og det har vel ikke skjedd på, du sier det mens du snakker med han, jeg husker ikke hvor langt.
Jeg tror det var 1980.
1980. Og jeg hørte nå intervjuet, og jeg synes det er jo kjempeinteressant, og det ene er at han bekrefter egentlig synspunkter vi har hatt på nettopp dette med, altså han bekrefter jo rett ut at sentralbanken har ligget bakpå når det gjelder, altså langt bak når det gjelder denne bølgen av inflasjon som vi har fått nå. Nå også litt grann om beslutningsprosessen, men mest interessant synes jeg er at han gjør det på en så grundig og pedagogisk måte, som jeg føler så til og med forsøkt å forklare en del av disse mekanismene og du også for så vidt i episoder som vi har hatt, så føler jeg at han er et godt nivå over oss når det gjelder å kunne forklare ting, forklare dette pedagogisk. Og jeg tror at den pedagogiske forklaringen gir innsikt, altså den tilfører noe, den tilfører lytterne kunnskap om hva det er som faktisk foregår, og at, ikke minst, at det som de legger vekt på er flytende. Med andre ord, det er ikke, i øyeblikket er det jo inflasjon fordi de er så langt bakpå, men det kan lett forandre seg. Altså vi har jo blant annet effektene på arbeidsmarkedet som kan dukke opp, boligmarkedet, ikke minst aksjemarkedet, som nåværende Fed-president Powell ble rett og slett tvunget til å ta hensyn til av forrige president. Som betyr at det er ikke en enkel innsatsfaktor som bestemmer hva de gjør. Det er mer komplekst enn det, og det har jeg for så vidt trodd, fordi hadde dette vært enkelt, så hadde ikke sentralbanken bommet så mange ganger som de har gjort på bruken, eller på å forsøke å mikromanage inflasjon. Og hvis jeg kan ta en ting til, så var det jo interessant hvor han sier at disse renteendringene, eller renteøkningene, så de rammer middelklassen først og fremst, og ikke de rikeste. Og nok en gang så har vi et myndighetstiltak som rammer middelklassen, og det er samme som skjer i Norge, hvor middelklassen rammes når egentlig intensjonen er en annen.
Supert. Men skal vi gå i gang med intervjuet da, like fort? Kan også si at han var teknisk sett sentralbanksjef som en del av FOMC-komiteen. Han var vel leder for, jeg tror det var Kansas City Fed. Så jeg synes ikke det er feil å kalle han sentralbanksjef i den grunn.
Nei, altså det er jo FMC som stemmer over rentesettingen. Altså FMC Board, altså styret som stemmer over rentesettingen. Så det er jo en fair, altså han er jo sjef på den måten at han har...
Han var sjef for én sentralbank, men ikke sentralbanken.
Ja,
det er ganske vanskelig å titulere han, korrekt?
Ja, på norsk. Ikke så vanskelig på engelsk, men på norsk er jeg enig. Men jeg tror alle rett og slett vil sette pris på å høre denne pedagogiske forklaringen, og de lange resonementene som man får lov å avgi på spørsmålene som du gir. Han gir jo enda lengre resonementer enn det jeg gjør, men jeg må jo si at jeg tar av meg hatten for pedagogikken, altså hans evne til å gjøre lytteren, eller gjøre det forståelig for lytteren.
Supert. Da går vi i gang med å hoppe rett inn i svaret på første spørsmålet, som er hans perspektiver for det som har skjedd det siste året, det siste kvartalet og det siste døgnet, var det som var spørsmålet. Så her er hans svar på det, og så går vi rett inn i samtalen videre fra det.
Well, I can give it a stab, as they say, and I guess I would start with the last year. I think that number one, Congress, and number two, the Federal Reserve of the United States did not exercise the kind of discipline that would have been necessary to avoid both this asset inflation that we've experienced and this price inflation that we've experienced over the last year. There had been pretty substantial monetary policy expansion since before, actually, the pandemic in the United States hit, and then it was doubled at the time of the pandemic. The economy, while it was still under stress, had returned much more quickly out of recession. And actually the summer of 2020, and for sure the late summer of 2020 and on, and yet the Federal Reserve pursued a policy of very crisis-oriented money growth, continuing its $120 billion of purchases every month throughout the year 2020 and 2021, slowed a little bit in terms of expansion from January to March 2022. So it was still a very expansionary economy just until March of 2022, very recently. At the same time, the government passed, three big spending bills from March 2020, and then again late 2020, and then again in the spring of 2021, and that had a kind of a element to it that ran several months. That is, direct payments to those who were unemployed, supplemental payments to those who were employed, even making good incomes. And so the spending was pretty aggressive for the government over that 2021 period. I think the Federal Reserve knew, because of the comments that the chairman made in the fall of 2021, that they were behind the curve on inflation, and yet they did nothing about it. And there's all kinds of speculations as to why. I don't know all the reasons. but certainly I think they knew that they were extending policy beyond its need. The outcome of that then was pretty significant inflation, more than anyone expected, certainly the Federal Reserve and certainly many within the White House and the Treasury. So when you have that 9% inflation, and then at that point, real interest rates significantly negative in the United States, and for that matter, even more so in Europe, I suppose. But nevertheless, you are in a highly unstable inflationary period. So then the Federal Reserve, at least, and some in Congress, until very recently, knew that they had overshot, and the Federal Reserve began its process of restricting monetary policy, but it did so very slowly to begin with. I mean, a quarter point in March, and their quantitative tightening, that is, the reduction of their balance sheet, which is huge. I mean, their balance sheet doubled between early 2020 and 2020, March of 2022. And so they began to talk about shrinking that, but very slowly. I mean, the first rate move was a quarter, a modest reduction in the balance sheet of $45 billion. That's supposed to come to $90 billion here soon. And that, of course, that entered the market as news, and the market reacted to that. Interest rates have risen. In the U.S., mortgage rates are substantially higher, over 5.5%, up from basically 3% or less. And so now you have this tightening going on and a lot of uncertainty, tremendous amount of uncertainty. So that's kind of the long run situation we find ourselves in, a highly inflationary, uncertain world in which the Fed is tightening, and the government has really not made up its mind to reduce spending. They've just passed a bill for subsidizing the chip industry and others, and then they're talking about a new bill as recently as yesterday for increasing taxes on corporations, but also part of that is tax credits and spending. So that part of the process continues. That is the spending process, I suspect. So now we're in the last few hours, I guess I'll say the last day or so. The Federal Reserve did as it was expected to do. It tightened policy, 75 basis points. And it is, without talking about it much, continuing its quantitative tightening by letting its government securities and its mortgage-backed securities, as they mature, run off rather than buy new ones, which takes a lot of liquidity out of the market. And so I think the outcome of that is more uncertainty, which I think is difficult for the economy. The stock market reacted positively. I think that important part of that is relying on some of the words of the chairman of the Federal Reserve, kind of waffling, if you will, on just how long rates will stay tight, which I think is what they're reading as not too long, not past 2023, and that's their reading of it. But that has an impact. But at the same time, the Fed is raised rates again. That they will probably need to do so again in the future. Congress, we don't know where the spending plans are going to be and where the tax plans are going to be, so that's uncertainty. And so the economy itself, I suspect, based on these events, will remain, if not, well, will continue to grow very slowly. The GDP number came out negative again. I'm not going to get into the definition of a recession, but I do know a slowdown when I see one. and we do have a slowdown, and I suspect that slowdown must continue given the recent rise in rates and suspected further rise, and we'll see how that plays out. But I do think the economy will continue to slow. I notice that unemployment claims are up. First-time claims are up. We still have a very low unemployment rate, but I suspect that will rise. I don't know what speed it will rise at. Depends on whether we have a financial setback in terms of stability, given these interest rate increases. That's an unknown. But I suspect that we will have this very slow kind of a quagmire of an economy as we move through the rest of 2022 into 2023. So that's kind of my prognosis.
It's very, very interesting points. First of all, I have to delete my question about is this a recession or a technical recession or because you already answered it. But what's so interesting about this is you're not only talking about monetary policy, you're also talking about fiscal issues.
Correct.
So what does the Fed, I mean, I know I asked you a similar question last time, but it still kind of baffles me a little bit. What does the Fed actually look at, and specifically Powell, of course, but what does the Fed actually look at and care the most about? Is there a hierarchy, or is it a little bit of a fluid situation? Do they change what they care about? Because if you look at the classical, it would be price stability, but you're talking about multiple factors here. And when you talk about unemployment rate, you can't forget about participation rate, which is very low now. So is it possible to answer what does the Fed look at, or does it attempt to look at everything? Is that really the issue?
I think the Fed looks at whatever the pressure point is on them most. And by that, I mean, in the pandemic, when unemployment was rising very quickly, they let all stops out, and they looked at the unemployment, and they wanted to produce a policy, a very expansionary, very liquid-oriented policy to address unemployment. They then gauged incorrectly, or for whatever reason, that inflation was rising, but it wasn't going to be their main concern at that moment until it became unavoidably something they had to deal with. And then inflation has become the target that they're looking at the moment. And that's part of the difficulty, because you don't know how to think about it going forward. If inflation stays high, but unemployment starts to rise, how will the Federal Reserve, how will the Open Market Committee react to that? And I don't know the answer, and I don't think anyone does, perhaps even members of the FOMC, because it is, in their mind, a trade-off, a short-run trade-off, perhaps it is, but a long-run trade-off, it is less, and they're not thinking of the long run. They're thinking of the immediate issue they have right now is inflation, and they're looking at that, but that could change. And that repeats, in a way, what went on in the 70s in this country, where we had inflationary increases, and they addressed that until unemployment started to rise, and they backed off. The economy improved, but inflation started to rise, so they raised rates, and then the economy slowed, unemployment started to rise, and so they lowered rates. And so that's the danger. The danger is whether they are steadfast to bring inflation down much more close to their 2% target, or whether they will be satisfied with something less than that if the unemployment numbers start to rise. So it's not a fixed target. And that's what I think we all have to realize.
Is it just general stability is their sort of measure, sort of this, like you said, you don't know exactly what it is, but you know it when you see it. Is it that kind of a approach they have?
Well, I don't know that it is. I mean, stability would be another factor if by tightening as aggressively they were to cause financial instability. The banks start to feel the pressure and begin to draw back or begin to show losses and so forth, and people become concerned about that. Those are things that could, in fact, influence their actions. But at the moment, it's primarily the shorter run trade-off between inflation and unemployment. And right now, inflation's the target. And I think Jay Powell said yesterday that he feels confident that the financial industry is prepared to deal with any of the effects of their tightening without too much difficulty, which is a pretty confident statement on his part, but only time will tell if it's an accurate statement.
In the last month, 2 months, there's been more and more talk about Fed's indicators and the fact that the Fed are using a lot of lagging indicators. I guess that's kind of because of Jay Powell has mentioned it, so he's brought it out. But furthermore, the decisions that are made the results are somewhat lagging, even though you get an immediate market response. The actual results take time.
Yes.
Is this a legit problem, or is it more of kind of an excuse for trying to sort of excuse away a recession?
Well, it's probably a combination. There is an excuse element to this. You can't to miss the inflation outbreak to the degree it did. Is hard to explain. Many people, professional individuals, were concerned about inflation well before the Federal Reserve began to take action. There's no avoiding that fact. At the same time, going forward, though, thinking forward from here, it is a reasonably accepted, perhaps universally accepted, I don't know, people might differ, but view and understanding, research supported, that policy, especially monetary policy, more so even than fiscal policy, acts with long and variable lags. And so the actions that have been taken, I think, are just beginning to have their place. And so this most recent 0.75% increase in the policy rate will have effects that won't actually finish until after the first of next year. And so they have to be mindful of that. But at the same time, since inflation is so high, they can't just pretend that they don't need to do more as we move through the rest of this year. And getting that balance right will be a significant challenge for the Open Market Committee. And that's why I think they also said we're not going to give guidance. You can't give guidance when you don't have a clear view, and I think that's why they want to be a little more cautious in their forward predictions. So that's what I think is going on. They're trying to get away from trying to predict something that they're not able to.
If you were in Powell's shoes now, or 12 months ago, rates were at the all-time low, and if you're able to avoid sort of 2020 hindsight fallacy, I guess that's not possible, of course, but what would you have done differently, or would you have acted similarly to Powell?
Well, that's a hard question because you don't know how you'll act unless you're in the chair and have all the pressures, all the political pressures and all the pressures upon you. My own experience would have suggested that I would have allowed for an accommodative policy, but far less accommodative than what the Federal Open Market Committee did from the fall of 2020 to March of 2022. I would have felt pretty comfortable taking that much of that stimulus away, would have kind of aimed at least for a more neutral rate much sooner. I think the economy could not only think, I'm confident the economy would have been able to deal with that, and perhaps would have served the economy better in the long run. But like you say, I could say that pretty confidently now in hindsight, but I would say, given my views expressed long before 2021, that it would have been prudent of the Fed to take a good deal of that accommodation away a lot sooner.
When it comes to inflation, this is potentially a very stupid question, but I've talked to other macroeconomists that don't agree with the premise of the question. But regardless, does it really matter what is the cause of inflation? So if it's supply or demand or whatever cause, inflation, in my view, is inflation. Prices are going up and are having all kinds of cascading effects. Also, second part of the question is, are we sure what has caused this latest bout of inflation? Is it the stimulus checks? Is it the extra spending during COVID? Is it QE finally? Like, do we actually know what is the trigger, the cause, and does it even matter?
Well, I start out by saying it certainly does matter, because you can't address a problem unless you know the source of the problem. I would say that, like all things, it is a combination of events. But first of all, on the supply disruptions, they will cause prices to rise as you ration the excess demand that's there because of the drop in supply. But that usually is more of a transitory effect. If, on the other hand, if supplies are the same or fall, but you stimulate demand, as the U.S. did and as other countries did, by, number one, increasing money, the base money, high-powered money, that then can be loaned and spent and affect asset price inflation and affect goods prices, because as you put more money in the hands, even in the banks to lend, you can precipitate inflation. And then if your government, with all good intentions, create additional demand through the spending by transferring money directly into the hands of the consumer or business or both, then you continue that stimulus past the adjustment in the supply disruptions and create an ongoing inflationary problem, which is what happened in the United States and to some extent, I think, globally. Now, what you're doing at the moment is trying to correct for that by shrinking demand, by removing the stimulus in terms of the money policy. And I'm not sure of the government's intentions in terms of its spending policies, but that's a factor that could affect future inflation, and so has to be thought about, I think, by the Congress and the president as we go forward. But the Fed can, in fact, pull down the amount of money, and that will serve to constrain demand to some extent. Now, remember The Federal Reserve also was a contributor to the inflation because when the government increased its spending, it did not increase its taxes. So it had to borrow all these funds. And the Fed bought in its open market operations and other means a good deal of that new debt that the U.S. government issued during the 2020-21 period. And that, of course, is further stimulus because it allows the government to spend money without raising taxes, which is constraining. And therefore, you actually can accelerate the inflationary impulse that spending created and that money creation created. And that's why I think it surprised people that inflation went up so quickly, so high. So there are causes to inflation. Some of them are transitory, but this was precipitated a little bit by the supply disruption and a very great deal by extreme monetary expansion and extreme government spending. Now, remember, in the U.S., at least, the federal budget between 2019 and 2020 went up 50%. And it stayed at that level in 2021. That is a huge increase in spending relative to the base. And I think it would be hard to argue that it did not contribute to inflation. And then the Federal Reserve monetizing a good deal of that by buying U.S. government securities and mortgage-backed securities, which affected the housing market as well. That is the responsibility of the Fed and its desires to stimulate the economy.
We've seen moves now by the Fed that's not been seen since the early 80s, I guess, with the double, triple rate hikes.
Yeah.
Do you think the cure might be worse than the sickness?
Well, not necessarily. If they don't address this, 9% inflation will become 10% inflation, will become 11%, and that is a huge regressive tax that affects middle class and lower middle class more than the wealthier. It creates instability in governments. Traditionally it has, and I think there's no reason why it would not do so going forward. Now, if they try and solve their problem overnight, then it better be a very quick overnight, because that bringing any extreme unemployment will create its own set of instability. But if you bring it down quickly but consistently, people know that's what you're doing, then you can get through this and get back on a level ground and have people employed again. And remember, easy monetary policy does not guarantee you improvements in the standard of living. For example, after the Great Recession, 2010, and its quantitative easing through that period, 2010 to 2014 and so, productivity in the U.S. did not increase all that much, and neither did real wages. Compared to the post-recession in the 90s, where following the recession, productivity improved far more than it did after the Great Recession, and so did real wages. And interest rates were actually higher in the period of the 90s than it was in the period following the Great Recession. So zero interest rates will not guarantee you wealth. It will guarantee you asset inflation. It will guarantee you, if there's also government spending or other direct spending facilitated by it, it can give you price inflation, but not necessarily guarantee you improvements in wealth and standard of living. And remember, zero interest rates created a worsening of the income distribution in the United States over that period, and that also created a great deal of unsettled it unsettled the public more than I think people are willing to admit.
On sort of an extension of what you just said, considering Powell's previous de facto boss was very into the stock market and used the stock market as a direct gauge of how well he considered the Fed to be operating. Do you think this has had a lasting impact on Powell? Do you think he now, because normally you don't consider that a central bank manager really cares about the stock market?
Right.
Do you think Powell is different? Does he care about the Dow Jones index still?
Well, I don't know the answer to that. I given the actions they took, it would suggest they do care, but I don't know what other factors. Like I said, the unemployment rate may have been another factor that bothered them more than the stock market. So that's not something I can answer. Only Powell can answer that question, I'm afraid.
So you don't, yeah, I understand. So commodity prices are now down.
Yeah.
We see a bunch of inflationary pressures that are easing. We see a bunch of signs that, at the very least, inflation appears to be peaking. Do you think that this is causing the Fed to move on to employment now, to look at employment for the next direction?
No, I don't. I think they would want more time, and they would want to see the inflation numbers come down, visibly come down more than they have. Or I mean, right now they're still higher than they've ever been recently. I mean, 9.1%. So they want to see that number come down. Commodities are down. Now the question is, will they stay down? And so forth. And that takes a little time to judge. So I don't think they're going to turn to unemployment. And remember, they're not going to turn to unemployment for another reason. That is, in the United States, it's very low. And they don't really need to at this stage. And that's why inflation is what they're watching, in contrast to during the early pandemic when unemployment was what they were watching. So I don't think there's any rationale for them to change from looking at inflation yet. I think, and remember also, as much as these two rate increases were 75 and 75, they're still early in the tightening cycle, and the effects of that, even the first 75 basis point increase, has hardly played out. So that has to play out for a while yet before they will be able to change focus or be wanting to change focus.
Last time we talked a little bit about reverse repo, and you gave a great perspective on it. Since then, the daily volumes, reported volumes, are going up virtually every day. And it's now, if I remember correctly, about $2,500 billion a day.
Mm-hmm.
Is there a limit, and why is the volume going up?
Well, I don't know that I can answer that question completely. There is no limit that I know of. The Fed can pretty much, I guess, take money out at that rate. I think one of the reasons that it's going up is they're trying to manage that interest rate, and the one way you do that is through the reverse repo, and that's what's
like a safety valve, kind of.
Yeah, it's kind of the back side of the policy where you can fine tune it more easily through the reverse repo, and that's probably what they're doing at the desk.
Is that partially because fewer people are watching the reverse repo than other things they're doing? So they can sort of operate more?
No, people are watching the interest rate, and that's what they're managing, and they use a reverse repo to help them manage the interest rate, is be my take on that. Others might have a different take on it and may have better information than me. I don't know. But it's primarily managed interest rates, I think.
Just one final question.
Sure.
I'm gonna let you go about your day. In my perspective and many people's perspective, banks appear to be very strong now compared to other downturns where we've had much weaker bank sectors. But in your perspective, how strong are banks really?
Well, I think they are. When people say they're better than they were, that's a fair statement when you think about it. I mean, they were very poorly capitalized at the Great Recession. And they are better. Now, when they report 14% capital, they're talking risk-weighted assets. But when you look at their leverage ratio at around 6% in the US and a little more than 4% in Europe, that's not a huge cushion if you were to have a downturn. The reason that the markets will accept that is the market's very confident that these banks, these largest banks, which in the US have more than half the assets, that they will be protected by the government. That's where the strength comes in.
Really? Wow.
And that's a fair assumption on the part of the markets and the public that they will in fact be protected. But if you were to ask me, are they well capitalized? I would say no. Their leverage ratio is 6%. A smaller bank in the U.S., a regional bank, will have 8 to 9%. A smaller bank yet will have 9 to 10%. So they are, they can, and the losses in the Great Recession were about 6%. So they can absorb, I guess, the losses, but people lose confidence a lot sooner than that, except for the fact that they are backstopped by the government.
That's kind of a surprising answer.
Yeah.
I would expect more of like the capitalization is much stronger now.
It's
The
not.
perception is that they are stronger.
They're better capitalized than they were, but that's different than saying they're well capitalized. If they were on their own and the government were not there, the market would insist that they have more capital. But they are protected, and therefore 6% appears to be a strong number. But it's only 6%. 6 cents on every dollar of assets backing it. That's how much they use of investor funds to fund their operations. There was a time when it was closer to 8, but that's the way it is. So I have held that view for years, and I think it's accurate.
It's a very, very interesting perspective, and thank you so much for taking time again to talk to us and teach us a little bit about your profession. It's genuinely very interesting, and
well, I hope the future turns out. Thank you very much, and I hope the future turns out well.
Yeah, me too. What do you think about the future then? What's your crystal ball telling you?
I think we're going to struggle for the next year and a half, and hopefully we will have learned something from this experience and get inflation under control and move forward. I hope that social unrest in this country, and I think in other parts of the world, I hope it settles down. It has a better chance of settling down if the economies stabilize. And so that's what I think everyone wants. And the fact that everyone wants that may allow us to get there if they're willing to cooperate and, shall we say, find that middle ground that's so essential for getting things done.
That's a great sentiment. I totally agree. But thank you so much, and I will log off now.